What's up guys, welcome to door number 17 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Today we are going to talk about another turnover ratio, the receivable turnover ratio. It tells us how quickly the company is able to collect its accounts receivable, aka the sales that were made on credit. It is calculated by dividing the net credit sales by the average accounts receivable. Let's say that company A's 2021 starting accounts receivable was $1 million. Now the accounts receivable are $1.5 million. This means that the 2021 average accounts receivable is $1.25 million. If the net credit sales are $100,000, the receivable turnover ratio is 8%. You can also calculate how many days it takes on average for customers to pay the sales on credit. This is done by dividing 365 by the receivable turnover ratio, so in our example. So what does the receivable turnover ratio tell us? The higher the ratio is, the better. This means that the company is collecting accounts receivable efficiently and that the customers of the company are able to pay their debts. The lower the ratio is, the longer it takes for the company to receive the money. This is a bad thing because basically time is money. $1,000 invested today will be more a year from now, so the longer it takes for the company to receive the money, the less valuable the sale was. You can again compare different companies in the same industry, but as always, use all the available information and ratios before making any investment decisions. That's it for today's financial ratio. Hit the like button if you found this video helpful and subscribe so you don't miss the future ratios. Have a great day and I'll see you tomorrow. Bye!